Hi there traders, this is Steve Miley and this is FX Explained and another Master Academy. So in today's Master Academy we're taking a look at fundamental analysis. So we're going to look at macroeconomic data, central banks, geopolitical events and corporate data and micro events. These are all different types of fundamental analysis. So let's take a look first at macroeconomic data. Macroeconomic data can be split down into what we usually see as three different tiers of importance. So in tier 1 we would see the likes of gross domestic product, GDP, employment reports and inflation reports like the consumer price index or CPI. So tier 1 data is going to be the most impactful onto financial markets usually if it's out of line with expectations, because this data is really showing us what's really going on in the real economy, and obviously what's going on in the real economy is going to then impact through into financial market assets. So changes in the different outlooks for GDP, employment, inflation for example are a reflection of the economy and then will directly influence financial market assets. So we're watching these data releases as they come. Tier 2 data would look at things like the PMI, the Purchasing Managers Index, or maybe industrial production or retail sales. Again, all looking at these because they influence the markets, because they are a reflection of what's going in the economy. And it could be argued that tier 2 data is often better leading indicators data of what's really going on in the economy before we see that come through into that tier 1 data. So tier 2 data clearly important as well. And finally, we're going to look at tier 3 data, far less importance with this data and usually less impactful on any kind of asset class that we may be looking to trade. So within the tier 3 data, we'll be looking at things like housing data, maybe trade data and various different sentiment surveys. So here we can look at the impact over time of macroeconomic data. We had strong US economic data throughout the first quarter of 2019 for the global economy and the US economy, and that strong US economic data allowing the S&P 500, this is the index of the top 500 stocks in the US stock market, stock exchange, and so the stock market, the stock exchange, the S&P 500 all moving higher as the global data, but more importantly the US economic data all looked very strong. We're now going to talk about another part of fundamental analysis, and that is central banks. So central banks would include banks like the Bank of England, known as the BOE, and the Federal Reserve, and also known as the Fed, or sometimes the FOMC. This is the decision-making arm of the Fed, the Federal Open Market Committee. And there are other central banks obviously globally as well, the ECB, the European Central Bank for Europe, the BOJ in Japan, the RBA, the Reserve Bank of Australia, the RBNZ in New Zealand, etc. All of these are important depending on the asset class you're trading. Obviously, the larger the central bank, the more impact it can potentially have on global asset classes. So what do the central banks do and what are we looking out for? Well, we're looking out for interest rate decisions, the days they meet and decide on changes of interest rates. And also in today's markets, we're looking for potential changes in quantitative easing and decisions on quantitative easing. We're also looking at meeting statements and meeting minutes. So not just the meeting themselves, but when they release the meeting minutes as well, or the statements after the interest rate decisions as well. So we're looking at those equally as important sometimes as the actual decisions or the quantitative easing themselves, because they've often been priced in. So sometimes the statements and the minutes give bigger market moves and more significant market moves because they've not been fully priced in. And then we also have central bank speeches. So when the various members of the central bank committees make speeches to the general public or in private, we get the transcripts of those meeting minutes, through those speaker minutes or those speaker speeches. And then from those, we can often see whether those speakers are moving maybe more hawkish or dovish, and whether the central bank is moving more hawkish or dovish. And we're now going to talk a little bit about hawkish and dovishness. What do they mean from a central banking perspective? Well, hawkish means more concerned on inflationary forces. So a hawk in a central bank, or a central bank that's hawkish, is concerned about inflationary forces. And they are likely to be favouring higher interest rates or maybe not cutting interest rates as aggressively. On the dovish side, a dovish central bank or a dovish member of a central bank will be less concerned on inflationary pressures and more concerned with growth and employment. So a dove is more likely to be wanting to cut interest rates, or in an interest rate hiking cycle, increasing cycle, less desirable to actually increase rates, will be less wanting to move interest rates higher, a dove. And here we can see the direct impact from a central bank. This is a very short-term 5-minute euro-dollar chart. A less dovish tone from the central bank. This was the ECB. So a less dovish tone from the ECB. So de facto, if they're less dovish than expected, they're actually then effectively more hawkish than we expected. And that saw the euro versus the US dollar, EUR/USD go higher. The euro rallied, the euro improved in value, increased in value because of the expectation of a less dovish, more hawkish central bank. Let's talk about geopolitics now. So geopolitics can include things like acts of God, earthquakes, hurricanes, the weather. It could be politics, elections. A great example of politics would be Brexit. It could be war, terrorism, or trade wars, like the US-Sino trade war that's dominated throughout 2018 through 2019. And here we have an example of just that, geopolitics. US dollar versus the Mexican peso. This was in June 2000, late May, early June 2019. The Mexican peso went lower. So that's US dollar versus the Mexican peso higher. We see that surge higher in dollar MEX, USD MXN, US dollar Mexican peso. And that's because that's a weakening of the Mexican peso after the US threatened tariffs on Mexico. Now we're going to talk about corporate data and corporate events. This could include earnings reports, which would be net income, profit margin, debt to equity ratio, and price to earnings ratio. All of these things, corporate data or corporate events. Also, any kind of mergers or takeovers would have an impact on an individual company, an individual corporate, and its stock price. And here we see just that happening. Corporate data event in here, it's actually the earnings report and the revenue report in here actually from late Q1 2019 from Google, from Alphabet, the parent company of Google. They posted disappointing Q1 2019 revenue, and pretty much the next day immediately there was an 8% price drop in Google, and then Google continued to sell off throughout May of 2019. So in this look at fundamental and introduction to fundamental analysis, we've taken a look at macroeconomic data. We've looked at central banks and their influences. We've looked at geopolitics and the corporate data and events impacts on individual stocks. Again, this has been Steve Miley for FxExplained and another Master Academy. Join us again soon. If you have any questions about this article or this video, please leave a comment below and I'll come back to you.